In this video I'm going to talk about the budgeting process, and for us it all begins with a sales budget, some expected level of sales, and from there we are able to derive all the other budgets that we need, both operating budgets and financial budgets. So once I know what I'm expecting to sell, and this usually comes from market research or marketing department giving us information as to what the market is supposed to be responsive to in terms of our product or service. Once I know that, then I will produce or generate a production budget. The production budget tells me how many units I need to produce based on an expected sales level, and from that I can produce my direct materials, direct labor, and manufacturing overhead budget. On the other side, this would be production related, but then on the non-production related side, I can come up with a sales and administrative budget based on my expected sales. These are the inputs right here. The operating budgets give me the inputs to come up with cash budget based on the cash inflows from sales and the cash outflows from these items here. And that gives me the inputs to be able to generate a cash budget. Additionally, I can create my financial statements, pro forma financial statements, based on these expectations. I can prepare the income statement, balance sheet, statement of cash flows, and the statement of retained earnings. As a quick example, just assume we have expected sales of 100 units. And if that's the case, then in terms of production, obviously I want to at least meet the expected sales level in terms of production. But what is very likely also is that I may want a desired ending inventory. So I don't just want to produce 100 units, I may want to have a few extra at the end of the period, just in case things are better. So we would add a desired ending inventory, and in the same fashion, we could already have existing inventory. So if we already have existing inventory, no need to produce that. So just to give a quick number here, if we were estimating the production budget, I would at least have 100 from expected sales. So that would be 100 here. And let's just say that we want to have 5 units extra. Then I would add 5, and that we currently have 2 in inventory. So my production budget would be for 103 units. And this is important because your materials, labor, and overhead budgets are based on the production level of 103, the expected production level of 103, not necessarily the 100 units that you plan on selling. Whereas the sales and administrative budget, it's going to be mostly based on 100 units you're going to expect to sell, but as well as the 103. When we generate our pro forma financial statements, for example, our income statement is going to be based on the numbers of expected sales of 100 units in terms of cost of goods sold, and then the balance sheet obviously will reflect the other 3 extra units that supposedly we may have in inventory. So overall, this discussion on the budgeting process really stems from being able to estimate what your expected sales levels are or will be. And once hopefully if you can accurately predict that, then all these other budgets would hopefully be in line in the future.